Okay, let's talk about Singapore. Now, I know that about 25% of you guys are from Singapore. That's what my team told me. So I'm going to talk about Singapore. Now, just to share with you, I have got my growth portfolio and my dividend portfolio. Now, my growth portfolio is purely US and China, okay? Because Singapore companies don't grow. The growth is anemic, all right? But Singapore market is only good for one thing and one thing only. Singapore stock market is only good for REITs, real estate investment trusts. And Singapore has one of the best REITs in the world, I would say, with attractive yields that pay good dividends and they are tax-free. So I only buy Singapore stocks for dividends. And I've got a portfolio purely for Singapore and Hong Kong companies that pay good dividends. Okay? Just give me a second. Let me just show you that portfolio. Just showing you that it's a separate portfolio which I have. Let me just log into that. Okay. Now, Singapore, like I said, is a very, very volatile market. Okay. In 2020, Singapore index went down 11% for the year. So a lot of people complain, oh, it's not fair. The Singapore market went down 11%. I'm losing money. Hey, let me tell you something. Don't blame the market. Be a man. Do the right thing. The good news is this. Even when the whole market is down, but if you know how to buy the right companies at the right time, you can still make money in a crap market. Yeah. Okay. So let me show you my portfolio that only has Singapore companies. And Hong Kong. And Hong Kong is down 3% as well, right? And this is my portfolio over here. Let me just open it up. It's on my phone. Let me just get it up here. Yeah. This is my Singapore and Hong Kong portfolio. And let me just show you, these are equities. So my portfolio was up 17% last year with the whole market minus 11%. Why? Because I only bought good companies, right? Oops, sorry about that. So this is the Hong Kong ETF up 27%. This Hong Kong ETF up 27%, 26%, 35%. Meituan up 300%. Ping An up 29%. Ascendus REIT up 6%. Escort more or less down 1%. CapitaLand Trust up 16%, CapitaLand Retail China Trust up 19%, Cromwell up 41%, DBS Bank up 17%, EC World 16%, Frasers Logistics up 45%, Hopper up 14%. So you can see that the majority of my stocks gain, even though the whole market was down. Ooh, what happened? I'm going to restart this. Damn it. Give me a second. Okay. So that's the good news. You can still make money in a crap market if you buy good companies and you know exactly when to get in. Okay. The Singapore market, currently the PE ratio is 21, which is slightly below the historical average. So Singapore is undervalued as well. But like I said, you got to only focus on the good companies. And for me, they are mainly the REITs and the 3 Singapore banks. Now, why? Singapore REITs, again, REITs are real estate investment trusts. Singapore REITs are among the highest yielding REITs globally. If you compare, Singapore yield is only second to Hong Kong and Japan, which is pretty close, right? So it's one of the best in the world. And I expect Singapore REITs to continue to recover and grow in 2021. What are the bullish factors? There's positive capital inflow into the REIT sector, rebound in net property income and distributions, which are dividends from rental, and inorganic growth from acquisitions funded by cheap debt. Okay. The good thing is that interest rates are very low, and many of the Singapore REITs have conservative debt levels. They have got conservative gearing ratios, which means that Singapore REITs have the capacity to borrow money cheaply and to buy more real estate to inorganically grow their dividends and their portfolio. So these are all the things it has going for it. The negative thing is the absence of strong rental revisions. So many of the REITs, they raise rents, right? But now they can't raise rents, especially the office REITs and the hospitality REITs. And that is the negative of the REITs. But there's more positive than negative right now. Now, specifically, what are the REITs that I like? So basically, when you invest in REITs, you have got office REITs, retail, hospitality, healthcare, industrial. Which are my favorite? My favorite would be industrial REITs. So industrial REITs make up the bulk of my REIT portfolio. Why? Because during the pandemic and the recession, industrial REITs, their property income still increased. That's right. They still increased their income and their dividends were not really affected. So their net income and dividends or distributions were the most resilient during the pandemic because they see continued growth from prime logistics centers and data center. In fact, this pandemic has boosted their business because as more people order online through e-commerce and greater supply chain diversification and people work from home, all this is accelerating the industrial demand for warehousing, demand for logistics centers, which is good for us who own these REITs. So my favorite would be Mapletree Logistics Trust, ticker symbol M44U, and Ascendus REIT, ticker symbol A17U. These are listed on the Singapore stock market. By the way, I'm not saying buy it tomorrow. No. Remember, it's not just knowing what to buy. You must know exactly when to buy. Okay? So in the value momentum investing course, I'm going to teach you exactly when to add shares. You only add shares at the right level, when it's undervalued, when the yield is still attractive, on the chart when it retraces to a buy point. So these are things that I'll teach you in the value momentum investing course. And if you want to mirror what I do, again, you can subscribe to the Ultimate Investors Playbook where you see me make live investments. Almost every day, in fact. All right. Second in line would be retail REITs. Retail REITs, they own shopping malls. Okay. So now be careful, guys. There are some retail REITs where the shopping malls are in the central district or on Orchard Road in Singapore. I would avoid those REITs like Star Hill Global. Why? Because these downtown malls rely a lot on tourists and office workers. And right now, there's no tourists. Officers are working from home and they are in trouble. So avoid REITs that own downtown malls. But suburban malls are doing really well. Suburban malls. Okay? Because now people are working from home. They go to the mall next to their house. They buy groceries. They go shopping there. And so suburban malls are doing really well. So REITs like Fraser Centrepoint REIT, CapitaLand Integrated Trust, and my favorite, CapitaLand Retail China Trust. If you go to China, the malls are packed. My cousin who lives in China, he says a 3 to 4 day waiting list for a massage in the mall. And that's why I was buying a lot of Chinese retail REITs that own these malls in China. All right, but it's listed in Singapore, by the way. Okay, next will be office REITs. Now, office REITs, you got to be careful because now there's weak demand as a result of companies downsizing, companies going out of business and more people working from home. So Singapore office REITs, I would avoid. I'll avoid Singapore office REITs because of this. But I have been investing in the Manulife US dollar REIT, and this owns prime office space in the US, in the suburbs. Why do I like this REIT? Because their occupancy is still very high, still 93% occupancy even during the pandemic. They've got long WALE. What's WALE? Weighted average lease, which means the tenants sign the lease for 5 years. So we are assured that 5 years, next 5 years, the rent will still come in. They don't have to look for new tenants. Okay? And their tenants are recession proof. You see, there are certain kind of companies where you can't really work from home because of sensitive information, like banks, like lawyers, like doctors, right? You can't really work from home, right? A bit difficult, right? So this REIT, majority of their tenants are financial companies and legal companies, and that provides the buffer for their high occupancy rate. My other favorite is Cromwell REIT. They own offices and commercial property in the entire European Union. And this has been doing really well for me. Up like, I think 30%, was it 40% you saw just now? And the yield is like still 7% yield. All right. So there are some good office REITs around. Okay. Finally, hospitality REITs. So hospitality REITs, they own hotel buildings and service residences. And hospitality REITs were hit the hardest by the pandemic, obviously because of tourism, right? So I would avoid hospitality REITs, except the only one I am still buying would be Escort REIT, because it has the strongest portfolio of properties that are diversified across 13 countries and 37 cities. And they are leveraged to their domestic market. So the domestic tourism would keep them going. And they have a lot of long stay assets, which are service residences, unlike hotels, right, where people stay in the service residence for a couple of months or years. So they've got those longer term income from that. Okay. So that's it. Those are my 2 cents worth on REITs.